Yes. Oh, yeah. I forgot. Idiot trade. Boom. Some nice returns on that. I guess we just close everything. What should I make? A little bit off. Yeah, I know I made, well, not quite max profit. 703.30. Time to update the idiot trade for day 11. 7, what would I say? 703? 703.30. 94% return. Not bad. So 359 plus 40, was that 40, 4301? Cool. Is there a better color for this? I feel like this doesn't contrast well. Maybe like a yellow, like a mustardy yellow. That looks like shit too, doesn't it? That's pretty good. Use purple? I could do cyan. I don't like that as much. That's too hard to see. Anyway, ding ding. You won't be able to see black at all. Okay, so moved up a little bit on SPX today. Not a ton, but within the expected move for the day, and kind of had our peak this morning right at the expected move. Failed and then closed kind of in between. A little bit of stagnation here as ES reaches a test of the long-term trend. We may get a breakdown, over like the next few days into next week. A little bit of a pullback, I think, would be good here. Maybe like 54.34 ES by sometime next week before another leg up. So maybe a pullback after Jackson Hole, but before we get out to the 1 second. Anyway, yeah, I could see this breaking down into the next week. 55.34 would kind of be a bullish test. 54.33, maybe a little bit more bearish or neutral. 53.60, very bearish. Commodities pretty flat today. Not much to say about that. Dollar obviously down hard on the day, but did turn around into the end of the day a little bit after the Fed minutes were mixed and leaned towards no rate cuts. Dispersion breaking down or pushing down a little bit more on correlation, so dispersion up. It's inverse correlation. But we did get a pretty big breakdown in it today, and I think this might be starting to bottom out a little bit. To get more liquidity to the upside, we're probably going to need some kind of pullback from our current levels, especially if we're going to push for an all-time high before September OPEX. The USD carry trade obviously turning around with those self-same Fed minutes, and forward yield on volatility ending the day just slightly positive. And we got, yeah, just a tiny bit of backwardation between cash VIX and the VIX contract in front there. Bond vol up again, but moving in line with correlation on the 3-month. Looks like some tail risk hedging was pulled back yesterday. 77.53% of the S&P over its 20-day moving average. VIX correlation still extremely positive and kind of flat on last week. And rate cuts. Fed Fund Futures pricing in quite a few more rate cuts today with the jobs data. Now, this isn't significant yet, but if we get above here, then people are starting to bet on a recession. Below here, pretty bullish. 1 or 2 cuts, even 3 by Jan. This is by Jan 25. This isn't so bad, right? Like, this isn't that bullish, but 1 and 2 cuts is bullish, at least in the short term. Definitely for small caps and mid caps. Anything more than 4 cuts by Jan of 25, people are starting to price in a recession. They're pricing in a extraordinarily rapid cutting cycle. Some of those cuts being like 0.5 per meeting, right? So yeah, we're the market's leaning a little bit more towards a recession with the jobs data, and this is the pinch point here, right? People have bought very heavily into U.S. Treasuries over the last several weeks, right? And I kind of talked about this the other night in Pickles Picks. But if we look at the 10-year bond, right? Well, today was rough. But this thing's crashed like 4 times since 2022, 5 times, maybe 6. And the cyclicality of this, it's a little bit easier to see out here on the weekly, but the cyclicality of this is really, really rough on bondholders. Now, it's great for banks, right? Because they can average out their hold to maturity securities on these peaks. and then they can buy back into the bonds on the troughs, right? However, this is like very volatile behavior for the U.S. 10-year. I mean, especially if you look, historically, it generally trades in a much tighter range over long periods of time. There's usually very few, crazy moves on it. And these last 2 years have just been nuts. This trough's getting higher. Something to worry about. Yeah, so it is kind of right because you're getting consolidation there, which means we're finding buyers higher and higher, right? But that's not exactly bullish, especially if we move towards a new low like we saw in October of 2022. And this is where the banks are really at risk, right? So yeah, not exactly great. It could be stabilizing, but I don't think it is. And I think if the Fed doesn't cut rates at the September meeting, we're very likely to revisit here, here, or here, and that's a big breakdown, especially given how much leverage was pushed into UST on this little tiny dip, right? Like this is a fairly sorry, this is a fairly insignificant dip compared to the prior two, but the amount of buying in treasuries significantly increased. Which means there's more money at risk should treasury prices decline rapidly again. And if the Fed doesn't cut, we're going to get, something similar to these events or like the bank failure. So keep an eye on that, I guess. If Uber doesn't move before Jackson Hole, is it likely to stay back below $2? Fubo looks really bullish. I mean, I don't know. It's looked bullish before and not really done anything. I would say if it doesn't climb much higher than $2, it's likely to fall back below 2. But 2 seems to have tons of interest. The tips are crossing over. Fubo's getting more liquid at a fairly significant rate, and volume is increasing since the initial gap up, which is bullish. People are buying out of the money calls on it. People are buying shares at $2. Generally speaking, if this were to continue out for a little while longer, we're likely to see a fairly significant amount of additional price improvement beyond what's already been seen. So I think it looks pretty good. Anyway, thank you guys so much for tuning in. I will see you bright and early tomorrow at whatever time I wake up. Later, guys.